Welcome back to Investing Talk Podcast.
Today we're looking at Lucid, the luxury electric vehicle manufacturer. They're known for that high-performance air sedan and the very highly anticipated Gravity SUV.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Lucid's current state. We've got a whole stack of recent financial data, some real product momentum, and frankly, some pretty critical financial maneuvers to unpack.
Right. It feels like we're watching a company trying to make that really difficult leap from just a high-end startup to a truly scaled global manufacturer.
That's the perfect way to put it. And when you look at the fundamentals, that growth trajectory is, well, it's undeniable, especially for how young they are in this space.
I'm looking at the TTM revenue. That's the trailing 12 months. And it's sitting at about $1.07 billion. But what really jumped out recently was the speed of their deliveries.
The delivery numbers were fantastic news. I mean, for anyone watching this stock, Q3 2025 saw record deliveries hitting 4,078 vehicles.
Wow, okay.
To put that in perspective, that's a 40% increase year over year. So it really proves that demand is solid.
Especially with people waiting for the Gravity SUV,
Like
right? It shows they're executing.
They absolutely are.
Okay, that's great news. But let's, hit the brakes on the enthusiasm for just a second. We have to talk about the core tension point here. Profitability.
The elephant in the room.
Exactly. This is where so many EV growth stories just hit a wall. That TTM net loss number is. It's massive.
It is, and you're right to highlight it. The TTM net loss is negative $3.14 billion, and that number is staggering, but you really have to understand the context.
Okay, so what's the context?
That loss is billions being invested in R&D, scaling up global capacity, and optimizing a very complex supply chain. It's sort of the price of admission for this industry.
So the key then is the trajectory. If you're burning cash that fast, they need a solid plan to narrow the losses. And, maybe more importantly, a huge cash buffer to survive until then.
Precisely. And analysts are modeling for those losses to narrow significantly as we head into 2026.
Why then?
Because that's when the Gravity SUV production is supposed to really scale up. They'll finally start achieving what's called operational leverage. All those fixed costs they've sunk in will get spread across more vehicles, driving the per unit cost down.
But the immediate safety net is the cash on hand.
Yeah.
And from what I see, Lucid's financial foundation is stronger than most startups its size.
It really is. They are sitting on over $4 billion in liquidity right now. That is a luxury that very few of their competitors have.
And that's not just cash from sales, right? It's heavily backed.
It's underpinned by the huge strategic weight of the Saudi Public Investment Fund, the PIF. This isn't just a friendly investor. This is a strategic state backer.
And they just doubled down.
They did. In Q3 2025, the PIF didn't just top up the tank. They expanded Lucid's term loan facility from $750 million to a hefty $2 billion.
That's more than just cash. That's a statement, isn't it? It basically guarantees a runway of well over 12 months.
Exactly. It removes any immediate worry about near-term solvency. It just buys them priceless time to execute.
It's like a geopolitical safety net.
It really is. With these high-growth stocks, the risk of running out of cash is always there. The PIF's commitment gives Lucid a kind of financial resilience its peers just can't match.
And speaking of savvy financial moves, they just did something interesting with their debt.
Oh yeah, the maneuver on their debt maturity. It was really proactive risk mitigation.
So what did they do?
In November 2025, they priced an $875 million offering of convertible senior notes due in 2031.
Okay, for anyone less familiar, convertible notes. That's basically debt that can be turned into stock later.
You got it. It lets them raise capital now, but allows the debt holders to convert that into shares later on, hopefully, when the stock price is much higher. But the really clever part was what they did with the money.
Right.
They used the majority of it, about $755 million, to buy back their near-term notes that were due in 2026.
Wait, so let me get this straight. They took debt that was going to mature in about a year and just swapped it for debt that doesn't mature until 2031.
Yep. They essentially kicked the can way down the road.
That's a huge vote of confidence in their own ability to be profitable within that new window.
It's a critical balance sheet stabilization move. They've aggressively de-risked their short-term debt, giving them a much longer runway for the Gravity ramp-up.
All right, let's shift from the balance sheet to the actual product. Because if you're buying all this execution time, you better have a product that stands out. What's Lucid's moat?
It really comes down to proprietary tech and exclusivity. Lucid is focused entirely on that premium segment. They're competing with high-end Mercedes and BMW, not the volume guys.
And the differentiation is what? Luxury and tech.
Exactly. Luxury interior quality, design, and critically, their battery technology. That range is still the industry benchmark, right?
Absolutely. They're still the gold standard, offering over 500 miles per charge on the air. That's not just a marketing line, it's a real technical barrier to entry.
For sure. And the Gravity SUV is so important because it takes that proven high-tech powertrain and puts it into the high-margin SUV segment. That's where all the market volume is right now.
And circling back to the PIF for a second, that partnership is more than just cash, it's also a logistical moat.
A huge one, particularly for distribution. The PIF is facilitating their global expansion, especially in the Middle East. As Lucid starts production and deliveries in Saudi Arabia, they are building a crucial beachhead for regional dominance.
Something that's almost impossible for competitors to replicate.
Exactly.
Okay, let's pivot to the chart then. With all this good news, record deliveries, debt swap, huge cash injection, why are the shares still trading so low?
Yeah, that's the big question. As of mid-November 2025, shares are hovering around $16.24. That's way below the 52-week high of over $36.
So a lot of the speculative froth is gone.
It is. What we're seeing now technically is emerging support stabilizing right around that $16 mark. The setup suggests what we call price compression.
So the volatility is tightening up.
Right. The short-term moving averages are converging, the stock is consolidating, and that kind of compression often happens right before a big move.
Up or down?
Up or down. But if that base holds and we get a positive catalyst, the immediate upside potential could be significant. The bullish 3-month range projects to somewhere between $16 and $22.
But the analyst community thinks the floor is higher than this current range.
Much higher. And this is the exciting part. While the consensus rating is a kind of lukewarm hold, which is pretty standard for volatile growth stocks, the long-term targets are way more aggressive.
What are they saying?
The average 12-month analyst targets range from about $24 to almost $28.
So that's a potential 30 to 70% upside from where we are now.
A huge potential upside. It shows a real disconnect between the market's short-term anxiety and the fundamental institutional belief in the company.
Okay, let's look ahead then. For anyone trying to track this story, what key events are on the calendar for the next 3 months?
The calendar is pretty busy. The biggest event is the Q3 2025 earnings release, which is set for December 2nd. The market will be laser-focused on delivery numbers, cash burn, and any progress on margin improvement.
And operationally.
We need clear updates on the full-scale Gravity SUV delivery metrics. Any good news on that ramp-up will be a major catalyst. We're also watching for the official start of production and deliveries in Saudi Arabia.
And then, of course, there's the fun speculative stuff, the rumors.
Right, the buzz never really goes away. There's persistent market speculation about a potential strategic buyout or a full take-private deal by the PIF. That chatter definitely influences sentiment.
And what about their tech? There are rumors there, too.
Yes, there's chatter about Lucid potentially licensing its advanced EV drivetrain or its battery tech to other major automakers. A big licensing deal would be huge.
It would validate their core tech and open up a whole new revenue stream.
A high-margin one, completely separate from selling cars.
But we have to bring it back to earth. What are the primary risks that could derail this whole thing?
Execution risk is still number one. They have to prove, quarter after quarter, they can scale production efficiently and manage that high cash burn rate. If the Gravity ramp-up slips, that $4 billion in cash starts to look a lot smaller very quickly.
And beyond their own execution, there's always the threat of dilution, right? They might have to tap the equity market again.
That's the sword that hangs over any capital-intensive company. And finally, you just have sector risks, intense competition and, macroeconomic headwinds that could slow down overall EV adoption.
So bringing this all together for you, our overall bullish rating lands at an 8.5 out of 10. That's really driven by the strong delivery growth, that ironclad PIF funding, and a very packed catalyst calendar.
The investment thesis is pretty clear here. Lucid looks attractive for short-term traders playing those news events, but it's also compelling for long-term investors looking for growth in the luxury EV space. The story for the next 6 months isn't just about today's volume. It's about successful execution and leveraging that institutional backing to finally reach profitability.
Right. And I guess the fundamental question for the market is whether the PIF, now that they're in so deep, has the patience to let this play out, or if the pressure of the EV raise means they might accelerate the endgame maybe through a buyout, much sooner than anyone predicts.